We've heard him speak confidently. We've watched him write convincingly about how to manage your money and grow your wealth. But the time has come to see if he's really walking the talk and putting his money where his mouth is. Or is he writing checks that his body can't cash? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And joining us today is David Kuo. He's the co-founder of The Smart Investor. Hi, David. Welcome to the show.
Hello, Howie.
So we've got a couple of quick questions for you before we dive into the meat of things.
Okay.
Do you have a secret vault like Scrooge McDuck?
Who is Scrooge McDuck?
Come on, you have to know who Scrooge McDuck is from the cartoons. He has this huge vault of gold coins. He goes diving in every now and then.
It sounds quite cute. No, first of all, I don't invest in gold, so therefore I don't have a vault for that. Okay. And secondly, whatever I have is put to good use all the time because, as you well know, and maybe your listeners might know, I'm an income investor. So therefore, whatever I have has to generate some kind of return. And I think locking it into a vault doesn't really achieve my objectives, which is to get cash flow constantly. I
think I knew that, because it sounds a bit like something I do. Yeah. Mattress, money under the mattress.
Some people might think that is a good thing to do, particularly at this time, because the world is very confusing right now. Yeah. And some people think that the best thing to do with their money is to
sit on it.
Just sit on it, hide it under the mattress, or put it into some kind of savings account somewhere. But that is the wrong thing to do.
All right. What about, say, on a scale of instant ramen to private jet to the moon? What's your typical Tuesday lunch?
Homemade stuff. Yeah, I like to cook for myself. I find it very therapeutic. I find it quite relaxing to cook. So I watch a lot of cookery programs on TV, and after I've watched them, I go, yeah, I think I could make that. Obviously, not to the same degree as some of these master chefs, but I really enjoy cooking.
Would you say then that's a surprisingly ordinary thing that you do, despite your extraordinary financial standing?
Well,
cook for yourself.
Well, I don't do it because I want to save money. I do it because I enjoy it. And surprisingly, going out to the grocery store, going out to the supermarket to go and buy ingredients is a bit like building portfolios. I hate to actually sort of bring in sort of money into this, but when you're building a portfolio, you need to make sure that all the components work together well in symphony so that you can have something quite beautiful. And I think cooking is the same. I go into a supermarket without any preconceived ideas about what I'm going to be cooking. I have a look to see what is affordable, what is cheap, what is economical, what is the bargain of the day. And then I use those ingredients for building my meal in much the same way that I use it for building my portfolio.
Why so frugal, though, David?
I'm not frugal. I'm not Kiamsap, okay? I am not somebody who is trying to save money. But what you want to do is to get value for money, which is different from being frugal. I'll give you a good example. There were some prawns. There were some prawns that were selling in the supermarket at $10. They cut it to $2.60. Would you not go out and buy it?
Sounds a bit shady.
No, it doesn't. No, it's just that it's getting close to its sell-by date. And so you buy it for $2.60. In fact, I bought 2 packs and I made garlic prawns that day because I had some garlic at home and I had some butter at home. So why wouldn't you do that? So it's a bit like building a portfolio. Investing is very similar to going to the supermarket.
All right. I'm going to have to put you on the spot then. How rich are you, David? Are you rich enough to buy a small island or rich enough to forget you bought a small island?
I'm comfortable, right?
What does that mean?
Well, what
Give
does
me
that
some
mean?
Numbers.
It means that I don't have to worry about whether or not I have money coming in every day. I am comfortable.
All right. So, do you think your definition of enough has changed as your wealth grew?
The way I would answer it is this. I'm not generating wealth for me, for myself. I see myself as a custodian for future generations. I see myself as a custodian for my children, my grandchildren, maybe my great-grandchildren. And so therefore, the responsibility is even greater than investing for myself. I don't make money for the sake of making money. I make money because I want to be able to let them have a better life.
What do you think were some of the biggest mistakes you made in the early years? Things that you regret and you would have changed had you known better, so to speak?
I think it's the same mistake that a lot of people make when they first set out investing, and that is that they don't know what kind of investor they really are. So a lot of people say, oh, I want to start investing. And generally I say to them, what is it you want to achieve? So I guess the biggest mistake I made in the early days was not knowing what kind of investor I was. And so I tried all sorts of things. I tried growth investing. I tried maybe some commodities. I tried currencies. I tried value investing. But it wasn't until I hit upon income investing that light bulb suddenly sort of went on. And I went, this is what I am. This is what I do. So if I can go back to food again, it's a bit like saying, what kind of chef are you? I'm terrible at making desserts, so therefore I know I'm not a pastry chef. So don't ask me to go out and sort of make puff pastry and stuff, because it's not me. And so the kind of cook that I am has taken a long time to evolve.
But does it hurt you when your investments lose money? You're supposed to know it all.
Right. So what does losing money actually mean, Howie?
I suppose it means, say you put in $1,000
Yeah.
and then the next day you look at it, it's only at 800.
Yeah.
Is the simplistic view, I assume.
Okay. Is that losing money? Really? Is that really losing money? Now, there are many times when I go out and I buy a share. So I go out and buy a stock, and the stock is at $1. And that stock is paying me dividends. And the very next day, the stock price falls from $1 to 90 cents. So according to your definition, I've lost. I've lost 10% of my money. But what you are forgetting is that that share is still continuing to pay me dividends. And regardless of what the share price is doing, that company is still doing okay. That company's profits are increasing. That company is growing its market share. That company is also paying rising dividends. So to say that I've lost money because I bought something for $1 and now it's worth 90 cents is, I think, one of the biggest mistakes that a lot of investors make, because you are conflating share price with winning. And that's not the point. The point is that share continuing to reward me whilst I'm holding it? Let's say that share that I bought for $1 is paying me 5 cents in dividends. That's a 5% dividend yield. And the next year, it pays 6 cents. The following year, 7 cents, 8 cents, 9 cents. So therefore, I'm not losing money. I'm only losing money on paper, but I'm not losing money actually, because I'm actually getting more and more income from that share. So I'm not losing money.
What about in the beginning when you were trying to figure out what kind of investor you were and doing these different things and losing money?
Right.
How did it make you feel? How did it not make you feel like retreating and not doing it anymore?
Well, investing in the early stages is a very steep learning curve. And so what you do is you have to accept the fact that if I have a pot of money that I'm going to be investing, there is a good chance that I'm not going to make money from that. But you are still learning throughout that entire process. And it's a learning curve. And it is only when you, as I said, that light bulb goes off and you know what kind of investor you are, that you suddenly become very confident. So in much the same way that I am explaining to you, I have a portfolio that I put $100,000 into, and the next day it drops to 90,000. Have I lost 10,000? No, I haven't, because I know that that portfolio is worth 100,000 based on all the metrics that I have, all the things like measuring the price to book, measuring the dividend yield. I know that that portfolio is worth 100. Whether the market thinks it's worth 100 is a different matter altogether.
What was the light bulb moment? How did you sort of figure out that dividend investing was it?
When you feel uncomfortable doing something, the moment you feel uncomfortable, then it means that you are not confident, you are not at ease. It is only when you suddenly become comfortable and you can sleep well at night, not having to worry. When I tried the various types of investing, currency, trading, investing in commodities, I was fretting all night. And investing should be enjoyable. Investing should not be keeping you up at night. But when I hit upon income investing, it was suddenly as though I was at peace with myself. And I could go to bed at night knowing full well that in 3 months' time, that company is going to be paying me a dividend. And when you have a portfolio of stocks, as many as I have, I get income dropping into my bank account every single day of the working week, Saturdays and Sundays accepted, and Christmas Day and public holidays when you don't actually sort of have anything going on. But apart from that, money is coming in every day. And I can predict to
the day
and the cent how much is going to be coming in.
What's dropping in today then? How much is dropping in today?
Today, I think Keppel will be paying a dividend. And so there are some Unilever shares that should have been paid on Friday, but because Saturday was a public holiday, they won't be dropping into my
account. We want numbers, David, numbers.
Enough, okay? Enough.
What does enough mean? Okay,
can you live
or let's say you didn't have to think about the next generation and such, right?
Yeah.
Could you live off your dividends?
Oh, of course, yeah.
So that's a person's ticket out of a proper job, you reckon?
Oh, for sure, yeah. But it requires a lot of planning. I mean, you can't expect to do it today and expect to be able to retire tomorrow. If you want to do something like that, it is a journey. And it is something that you will have started maybe 10, 15, 20 years ago.
How long did it take you to get to the point where you can say, you know what, I don't need the job anymore.
Okay.
I'm going to stay at home and make my granola and such.
We're back to cooking again. Okay, so what you need to do is to work out what I call the magic number. And the magic number is how much do you need to live off, right? What is the income that you require that will be able to replace the salary that you are previously getting? And you need to know what that number is. If you don't know what that number is, then it is almost as though you are driving from here to Changi Airport and you don't know the route and you'll be going all around Singapore trying to get to Changi Airport. So you need that GPS. And those are the parameters you need to work out. The moment you do, then you're laughing.
So you don't at all put anything in, say, high growth potential. You just do dividend reliability.
Did I say that? I didn't say that, Howie.
Okay.
Okay.
So
What I said was that you need to be able to achieve that salary independence. Now, the portfolio is made up of a number of things. So if we go back to cooking again, if I only gave you 2 ingredients to cook, it would be very difficult to prepare a meal that would be satisfying both for you and your family, right? It'd be pretty boring. But if you can add to that some stuff from your pantry, some spices, some herbs and stuff, then you can actually make a dish that is quite palatable, if not quite delicious. And in much the same way as when you build a portfolio, yes, income is important, but your portfolio also needs to grow. The problem with a lot of income shares is that they pay you a lot of dividends, but they don't grow an awful lot. So there are many real estate investment trusts, REITs, particularly here in Singapore, that might have dividend yields of 5, 6, 7, in some cases, maybe 8 or 9%. They're very high income generating stocks. But it's not going to make your portfolio grow that much. What I have in the portfolio is a base of good income generating shares. Then you have some growth shares on top of that. And laid on top of that is some value shares. So all the work that I did in the early days when I was learning about investing, it helped. It helps now to be able to build that portfolio. So none of that time was wasted.
Yeah, you talked about you've gotten to dividend investing and how you sleep much better at night. How do you then coach yourself, though, when volatility strikes? Or do you even need to? You still sleep through it?
Well, volatility is only... A lot of people conflate volatility with risk. They say that because a share is volatile, therefore it's a risky share. But the market does some very strange things to you. You can buy something that you believe is worth, say, $10 a share, and the share price can fall tomorrow. That's volatile. But the underlying intrinsic value of that share has not changed. It doesn't change from day to day. So what you need to be able to do is to say, yes, I've done my arithmetic properly, I've done my analysis, and this share is worth $10. What other people think is irrelevant to me because I know it's worth $10. And so if we get that volatile moment when the shares do fall, let's say it falls to $8. If my calculation is correct, that is worth $10, then I would pile more money into that share because I know it's worth $10. So going back to those prawns again that we talked about earlier on, I know it was worth $10 and now it's worth $2.50 or $2.60. Why wouldn't I buy it? Because I know it's worth $10. If I don't buy it today, well, tomorrow when they restock the shelves, it's going to be $10. So I would be missing out. So volatility is fine. I just see it as an opportunity. So I don't worry about that.
Let's say your entire fortune disappears tomorrow. What are you going to eat? Since we're on the subject.
Well, first of all, I don't think that's ever going to happen.
Let's just say...
Okay, I know what you're saying. But what you do as an investor is to make sure that you are properly diversified. So in order for that to happen, Howie, the American, the UK, the European, the Japanese, the Singapore, the Hong Kong, the Malaysian market would all have to collapse in order for me to have nothing. But let's play your game. Let's say that does happen, that I have nothing left. Well, first of all, you try to make sure that that doesn't happen by ensuring that some of your money is available for you. And what I do recommend for a lot of people is that they have at least 3 to 6 months worth of money that is available for them in case they lose their jobs tomorrow. Because in this volatile world that we're living in, particularly with AI and everything that is going on, a company could turn around and say, I don't need you anymore, and you're fired. So you get your redundancy pay, and it could take you 3 or 6 months to find the next job. And so you need to make sure that you have some kind of lifeboat that will enable you to sustain yourself. But going back to what you're saying, in that horrible situation where I have no money left, then I would have to start living below my means. And so you need to know how much you need in order to survive, because you obviously need to live. And maybe in that situation, I would have to go out and start all over again and just pick myself up. And with my lifeboat fund, I would have to reinvest that and try and sort of grow my wealth all over again. It happens to people, Howie. I mean, we might say it's not going to happen, but look at some of those people who are refugees. They have to leave a country with nothing. And I come from a whole family, well, a whole generation of refugees. My grandfather had to leave China after the war, and he went to Hong Kong. And my father left Hong Kong to come to Singapore. So I have this refugee mentality all the time, knowing that, yes, nothing is ever 100% secure, and to make sure that you do have enough in case disaster does strike.
How do you keep yourself mentally healthy, I suppose? Are there personal routines or habits that keep you sound, if you will?
Are you saying I'm going gaga or something?
No, I'm just saying, given the refugee mentality, how do you keep yourself sane almost?
By being positive, by knowing exactly what you are doing. And throughout my entire life, I have tried to improve myself constantly. I do a lot of writing. And that's the other thing that I do now, because I know that I'm not a young man anymore, Howie.
Oh, come now.
I'm not a young man. No, seriously, I'm not a young man. So what I want to do is to pass on whatever I know to other people, not just my children, but to other people as well, and to distill 30 years, 40 years of investing into books that people can try and understand what investing is all about, and not to be afraid of failure.
What about advice that you often hear, financial advice, that you feel is just plain wrong, gets your goat, people keep going for it, people keep saying it?
That the stock market is the casino for the rich. That is something that I hear a lot of people say. I don't want to go into the stock market because, number one, I need lots of money to invest. Number two, it's just a plaything for the rich people where they go in and go out and sort of make money. That is just plain wrong. I mean, the stock market is a place where companies try and raise capital, and it gives the ordinary person the ability to put money into those shares, pick the right shares, and I think you won't go wrong. And it is a great way to generate wealth. Normally, stock markets around the world will go up around sort of 7 or 8% a year. And if you factor in inflation on top of that, maybe the real rate of return is about 5%. That is pretty good. And going back to the nominal rate, if a stock market goes up 7% a year and you pick a portfolio of shares, even if you don't pick a portfolio of shares, you buy the exchange traded funds, the ETFs, you will be able to double your money in every 10 years, right? That is how it works. That's not that bad, is it? So learn how to invest and ignore all of that noise about volatility in the market and all those rumors about what is going on. I mean, right now, people are so concerned about interest rates and whether or not the Federal Reserve will be packed by the president's own people. But what I've learned over the years is just ignore what the Fed does and just do what you think is right. And I don't think you will go too far wrong. And on that point about packing the Fed with the president's own people so that the Fed will vote the way the president wants, you know, when you put a fox in charge of a hen house, it's a disaster. And what goes up?
It's winner, winner, chicken dinner.
If you put a fox in charge of a hen house, one thing that will happen is that egg prices will go up. Yeah.
I wish we had more time, David. Thank you so much for being so candid today.
You're welcome. Thank you.
David Kuo, co-founder of The Smart Investor. This has been Money Hacks by the Business Times. I'm Howie Lim.